हेलो रिद्धि। हाय, गुड इवनिंग संदीप जी।
गुड इवनिंग। ये कोहोस्ट किस किस को बनाना है? रिद्धि को बता दो उसको।
कोई रिद्धि कोई बोल रहा हूँ मैं, मुझे कोर्स बना दो। एवी मंजूनाथ।
और प्रेजेंटेशन कौन कर रहा है? एबीपी वाला?
वो मैं ही करूंगा।
अच्छा, वो नहीं कर रही।
और ये
नितिन, वो स्पीकर को तो बनाना है ना वो।
हाँ, स्पीकर को अभी ज्वाइन नहीं हुए वो।
हाँ, बस उतना ही कोहोस्ट जरूरी है, और तो कोई जरूरी नहीं है उसको।
नहीं, और एक है परमार, संगीता परमार, वो इंट्रोड्यूस करने वाली स्पीकर को।
ठीक है।
उसने अभी ज्वाइन किया नहीं है।
आप ये है ना, उसमें लिख दो, इसमें चैट बॉक्स में लिख दो उसको।
वो ज्वाइन तो किया नहीं ना उसने। अच्छा,
नहीं, आप
रिद्धि को।
चैट बॉक्स में नेम लिख दो उसको, रिद्धि के लिए।
वो क्या नाम से ज्वाइन करती पता नहीं ना। लोग कोई ऐसे आईफोन वगैरह या कोई ऐसे अजीब नाम रखते। HCD करके कोई है, वो पता नहीं चल रहा कौन है।
HCD? अच्छा, हाँ चलो। अभी तो आपका और मंजुनाथ जी दो आए ना जिनको कोहोस्ट बनाना है।
हाँ, एवी मंजुनाथ जी तो को होस्ट हो गए।
हाँ, आपका भी हो गया, चलो ठीक है।
आपको करना है क्या? आप भी कुछ करने वाले हैं ना, वो स्टार्टिंग रिमार्क।
नहीं, रिमार्क के लिए तो कोहोस्ट की जरूरत नहीं होती, वैसे तो कर दो, करना हो तो कर दो, चलो कोई। मेरा नाम भी लिख दो उसमें, कोई बात
Sangeeta Parmar wants to go again after introducing because her son is not well. That's what she said. श्रीनिवास सुब्रमण्यम ने आयन वक्त पे नहीं बोल दिया ना।
वो हमेशा ऐसे ही करता है, जब वेबिनार वो भी करना था ना कोऑर्डिनेशन, तो भी ये हो गया वो हो गया करके।
नहीं, वो बीमार है। ठीक है, बीमार है कोई तो क्या बोल सकते।
बोल तो कुछ नहीं सकते, बोलना क्या है।
हेलो मिस्टर मंजुनाथ, गुड इवनिंग।
Good evening. Good evening.
How are you?
Yes, fine, fine. Thank you, Sandeep ji. Good evening, sir. My role is to propose vote of thanks. No.
Yeah.
Okay. Thank you so much.
But for that you will have to attend the full webinar, तभी तो vote of thanks होगा।
Yes. I'll attend. 6:30. We're going to start.
उसको स्पीकर को तो एक बार मैसेज कर दो, वो ज्वाइन नहीं है।
अराउंड 6:20 बोला था मैंने उनको।
हाँ, फिर भी मैसेज डाल दो, रिमाइंडर हो। और धमीजा जी क्या हाल है?
बहुत बढ़िया जी।
और आपका हो गया ऑपरेशन वगैरह?
हाँ हाँ, हो गया जो इस आंख में था।
अच्छा,
तो
तो रेडियो वेबिनार करने के लिए
अभी आपसे मतलब ऐसा है कि मुझे एक बार डॉक्टर से बात करने के बाद, वो मेडिसिन तो चल रहा है, जैसे ही वो ओके होता है तो डेफिनेटली कोई अच्छा सा टॉपिक जो है
टॉपिक तो लिया भाई साहब ने, प्रेफरेंस वैल्यूएशन ऑफ प्रेफरेंस शेयर का।
नहीं, हम लोगों ने एक और अच्छा कोशिश करी है बनाने की, ब्रांड वैल्यूएशन पे, ट्रेडमार्क नहीं।
अच्छा,
एक
ठीक
और लेवल थोड़ा सा ऊपर, तो
ठीक।
उस पे मैं
तो
कुछ बना रहा हूँ।
अभी 1 महीना है, अभी 18 फरवरी को देखो, पहले नितिन जी कर रहे थे, अब इनको कुछ काम आ गया तो 18 फरवरी में स्लॉट हो सकता है आपके लिए।
हाँ, मैं आपको बता दूंगा, क्योंकि और भी चीजें हम लोग सोच रहे हैं। और
सोच तो रहे हो, हमको तो पहले से सोचना पड़ेगा।
नहीं, अब ईएसजी है, देखिए ईएसजी पे हमें बहुत कुछ मटेरियल मिल रहा है, और उसको वैल्यूएशन से लिंक कैसे किया जाए। मतलब थ्योरी तो सब हो जाएगी, प्रैक्टिकल कवर होना चाहिए। जैसे ब्रांड में हम लोगों ने काफी कुछ जैसे 3 बड़ी वर्ल्ड लेवल की 3 ऑर्गेनाइजेशन है, जैसे ब्रांड फाइनेंस है, ब्रांड जी है, इंट्रा ब्रांड है। ये लोग वैल्यूएशन कर रहे हैं टीसीएस की, टाटा की। तो वो कंसेप्ट हम ला के ना जी, मैं अपनी प्रेजेंटेशन में कवर करना चाहता हूँ। अब मैंने अभी पीछे किया था सीओपी में और सीपी में, इंस्टीट्यूट का ना, आईसीएसआई आरबीओ में। तो वो एक नई चीज कुछ लाना चाह रहे हैं।
हाँ हाँ, नहीं करो आप, आम तो सभी करते हैं, आप तो खास हो।
नहीं नहीं, वो तो क्या है कि जितना आप करोगे ना, उतना आप तैयार होते हो। तो नितिन जी से हमारी मुलाकात नहीं हुई। नितिन जी,
गुड इवनिंग सर।
नितिन जी हमारे एकदम बहुत ही वरिष्ठ सदस्य हैं, एकदम ये जो
नहीं, मैं बात बताता हूँ। ये हरीश हरीश जी से मेरी बात हुई थी जब मैं वैल्यूएशन का एग्जाम लिखने के पहले। उनको मैंने पूछा था कि कैसे अप्रोच करना, जरा बताइए। तो उन्होंने काफी अच्छी तरीके से मुझे बताया था कि कैसे करना है, कैसे
हमने भी
अप्रोच करना
इन्हीं से
है।
पूछ के पास किया था एग्जाम, मैं तो इनसे
हाँ,
गाइडेंस लिया था तभी पास हुआ इनसे लेके।
अच्छा अच्छा, नितिन जी।
नीतीश जी, गुड इवनिंग। नीतीश सर। सर आप म्यूट है।
तो नितिन जी, आप कहाँ से ऑपरेट करते हैं?
गुड इवनिंग सर, गुड इवनिंग एवरीवन।
गुड इवनिंग
गुड इवनिंग
सर, आई एम इन नासिक।
अच्छा, नासिक से।
या मंजुनाथ इज लुकिंग लाइक ए पायलट।
वो तो ऐसे ही लगते हैं, वो जब अपना वेबिनार कर रहे थे स्टार्टअप में तब भी पायलट की सीट पे ही थे एकदम, मंजुनाथ जी।
Good evening, sir.
या गुड इवनिंग। हाय संगीता।
Hi.
थैंक्स।
Am I audible?
यस
यस यस, वेरी मच।
Okay. Thank you.
So this will be the agenda.
नीतीश जी को तो जानती है धमीजा जी, नीतीश जी जो है इंडिया के फर्स्ट 3 एसएफए वैल्यूअर्स में से हैं हमारे।
हाँ, नीतीश जी को तो मैं बड़ी करीबी से जानता हूँ। 24 दिसंबर को आईबीबीआई ने फिजिकल एक वेबिनार किया था, कैविएट लिमिटेशन डिस्क्लेमर पे। अब हमें नीतीश जी वहां मिले थे, और
अरे IBBI ने जो पहले 5 व्यक्तियों को सम्मानित किया था उसमें एक ये भी थे एकदम।
मैं इनकी क्लास मिस नहीं करता।
हाँ
नीतीश जी की तो
सही बात है।
सर ये आपका प्यार है, आपका आशीर्वाद है, जो मौका मिलता है हमें अपने थॉट शेयर करने का बार बार।
नहीं, बिल्कुल आपकी एक्सपर्टीज है ई शॉप में, बाइनोमियल में, और भी आपके एक्सपर्ट एरिया में। मतलब शुरू के यही तो एडवांटेज होता है ना जी। एक
हाँ ये तो पायनियर है एकदम वैल्यूएशन के।
बिल्कुल बिल्कुल।
गुड इवनिंग संदीप जी। सर गुड इवनिंग।
गुड इवनिंग।
गुड इवनिंग।
गुड इवनिंग सर।
So Nitish ji, your main practice is valuation or in the common CA practice?
So mainly into valuations, and I am into India's consultancy as well.
Okay, okay. Because as far as qualifications are concerned, your plate is full. Many things are there.
Now we are moving towards forensics audits also.
Okay. Yeah, I saw that you are FAFD also. Or you are ISA also?
No, not DISA. DISA I am, yes. DISA,
you are
not CISA.
Not CISA, okay. FAFD तो मैंने भी किया हुआ है.
We are also empaneled with IBA for borrowings less than 50 CR, category 2 firm.
Great.
But everything depends upon the lining.
Yeah, obviously. That is.
At
That
least
is the biggest
initially.
problem.
At least initially, sir. At least initially.
लाइजनिंग इज लाइक यूरोप में आप टिकट खरीदते हो ना और ट्रेन में चढ़ते हो, लेकिन जब तक वो वहां पे पंच नहीं करते आप इसमें, तब तक वो वैलिडेट नहीं होता टिकट आपका. सो सिमिलरली
Right.
योर क्वालिफिकेशंस आर नॉट वैलिड अनलेस एंड अनटिल यू गेट दैट लाइजनिंग, उसका जो वैलिडेशन मिलता है.
सही बात है।
Good evening, everyone.
गुड
गुड
इवनिंग।
इवनिंग.
Good evening, sir.
हाउ आर यू प्रशांत जी?
All well, sir. Down with COVID.
Down with COVID.
माय गॉड.
Yeah.
अभी कोविड है ना, आम सर्दी जुकाम जैसे ही हो गया.
हाँ.
हाँ ये ओमिक्रॉन में तो ऐसा
टेस्ट
ही
किया
है।
तो पॉजिटिव ही आता है, इसलिए
नहीं,
टेस्ट करना ही नहीं.
हाँ टेस्ट तो नहीं कर रहे लोग बाग, लेकिन स्टिल वो फीलिंग तो है ना, फीवरिश काफी ज्यादा, बॉडी एक बहुत है, एंड थ्रोट में भी काफी ज्यादा वो इरिटेशन है.
ब्रिटेन ने तो सारे निर्बंध निकाल दिए.
हाँ.
दे आर नॉट इवन नाउ वेयरिंग मास्क्स.
यस, ब्रिटेन ने निकाल दिया है. हो जाएगा हमारे इधर भी नेक्स्ट, आई थिंक अनदर 1 month.
मुंबई वाले भी तो 24 से स्कूल वगैरह सब खोल रहे हैं अभी तो.
हाँ. और क्या, अभी बहुत हो गया, गवर्नमेंट ने बहुत समझा दिया कैसे रहना है, नहीं रहना है मत रहने दो ना.
करेक्ट.
उसके लिए सबको क्यों परेशान करना है, जिसको जैसे रहना है रहने दो.
राइट.
1.5 साल हो गया, तब अब तक नहीं समझे तो अब क्या समझेंगे. अभी बहुत सारे लोगों को जबरदस्ती वो होता है कि नहीं ऑफिस में जाना ही है, ये करना ही है. Unnecessarily people can really avoid, even then also people are not avoiding.
लेकिन इससे एक बात हाईलाइट हो गई ना कोरोना से, कि हम ऑफिस नहीं भी गए तो चलता है, घर में बैठ के सब काम कर सकते हैं.
कर सकते हैं.
कोई जरूरत नहीं बाहर.
और टाइम कितना बचता है, बिकॉज अभी देखिए 6:30 तो 6:30 एवरीबॉडी लॉगिंग इन. नहीं तो बैठे रहो, इंतजार करते रहो, एक क्लाइंट आके बैठ जाएगा, आधा 1 घंटे तक चाय पीते रहो, बस अपना भी पेट खराब करो, उसका भी खराब करो.
हाँ ट्रैवलिंग टाइम तो बचता ही है. पहले एक सेमिनार था तो फुल डे ही हो जाता था, अब तो 2 आवर है, 2 आवर ही है.
हाँ, और कहीं से भी कर सकते हैं. इट इज गुड. कोविड ने बहुत कुछ अच्छा भी बता दिया. शुरू करें, कभी करें?
हाँ 1 मिनट है 18 to 20
one minute is still.
अच्छा, ओके ओके।
अभी भावे जी का तो आई ऑपरेशन होना है, तो बस
हाँ।
हम थोड़ा सा करते हैं, फिर नितिन जी कमांड ले लेंगे।
नितिन जी आजकल कम दिख रहे हैं।
हाँ यार, मैं थोड़े मेरे बेटे की शादी के चक्कर में हूँ।
शादी फिक्स कर ली है या?
नहीं
Fix
फिक्स
कर
कर
लिए
लिया,
अभी
अब ये तो डांस वांस प्रैक्टिस कर रहे हैं ना आजकल ये।
हाँ,
अच्छा, ऐसा
28
है क्या?
फरवरी 28 फरवरी में शादी है, नासिक में है।
नासिक, ओके, ठीक है। चलो।
पहले मुंबई में थी दिसंबर में, बट
हम्म,
बिकॉज ऑफ सम वीजा का प्रॉब्लम हो गया था बेटे का। इज इन यूएस ना,
अच्छा, ओके।
तो
he is
उसका
safe there?
स्टैंपिंग का डेट। हाँ,
He is safe there, no?
या
आजकल
इज
बहुत
सेफ।
ज्यादा
हाँ नहीं, ही हैज बीन वैक्सीनेटेड, उसने बूस्टर डोज भी ले लिया है।
बूस्टर डोज, हाँ उधर तो बूस्टर डोज भी
चलो स्टार्ट करते हैं संदीप जी।
हाँ राइट राइट।
Okay. So I request Sandeep ji to begin the session. Good evening all. Sandeep ji,
evening
over
all.
to you.
Yeah.
You can
Yeah.
begin the session.
Okay, good evening all. As you know, today we have a CEP webinar of AVP. Ours is the Association of Valuation Professional, wherein most of the members are CA, CS, CMA, insolvency professional, and registered valuer. We have more than 150 members currently, and many renowned members are also there, like BSc former chairman, former chairman of CMA institution, and many industry and big leaders also. We have members from all the field, and anyone interested in valuation can be our member. For today, our speaker is Nitesh Chugji. So he is a renowned person in the field of valuation. He is one of the first among professionals who passed the RV exam under IBBI. So he is in pioneer and well versed in all the field related to valuation. He is professional CA and India's expert also. So we will have a wonderful session from him. This time attending the CP webinar is free for all, but for CP hour we have some condition. We have tie up with one RVO. By doing the formality, one can get CP hours also, but knowledge wise we have kept this free for all. Anyone attending this can attain the knowledge, and today source of knowledge is Nitesh Chugji. So Nitin Brahmaji will now take over and start the proceeding.
Yeah, thank you Sandeep ji, thank you very much. Now I'll brief you all on the AVP. Most of the things have already been briefed by Sandeep ji. So I'll just run through these slides quickly. Especially I'll dwell upon the upcoming webinars, which I'll brief, so that you can always find that easy to decide when to join, which webinar to join. So these are all slides. As Sandeep ji said, we have CEP, ours tie-up with IIV RVF, that is the RVO in Pune. We have already crossed 155 members, and we publish e-newsletters every month. So far 8 e-newsletters and 1 independent special newsletter we have published. We have conducted 42 webinars so far, covering different topics held by different people, who some of them are legends. Then I will not dwell upon this slide because this is particularly done by the person from IIV, but briefly I'll give you the introduction of IIV RVF. Ilyas Sheikh is the managing director, and they promote, since they are the RVO, they promote the profession of valuers by conducting the training, starting from the 50-hour training at the start, and then conducting the knowledge webinars like we are conducting in collaboration with them today. They have around 1,400 members they have trained, and 46 members are successfully registered with IBBI. Then SME Chamber of Commerce also we have a tie-up. So by having different tie-ups with different apex institutions, we get a lot of knowledge. We gain the advantage of having a tie-up with them because they have worth knowledge worth which we can benefit from, and we can also impart some knowledge to them, hopefully. We appeal all the new people who are not yet the members of AVP to join them, because as we said that we conduct the webinars which are free, and we are mentoring the newly registered valuers as well as the valuation students who have not yet cleared the examinations. In the initial period of AVP, we did conduct the webinars for the benefit of the students who are appearing for the examinations, like how to appear, what to do, etc. All those things we covered earlier. We are a national and international level because we have a presence in international. Our members are there in USA, Australia, and other countries also. Then we, if you become a member of AVP, then you can participate in all those activities. You can yourself be a speaker in webinars. Then you get international webinar chance to attend international webinars at a discounted price. Then you can take benefit from the study groups and the knowledge, the institutions which we have as a collaborator with us. And with you, mainly you get CEP hours. Those who are RVs, they will get CEP hours. 16 CEP hours are required per annum. So you can get the benefit of those CEP hours. And the joining fee is only 5,000 rupees for the entire life of the person. That is a life membership. So at 5,000 rupees, which is peanuts, you can always join and take all those benefits. Then upcoming webinars, there are some webinars which are there in the month of January, and then there are 2 webinars in the month of February. Then these are for March, April, May. I will not run through, or rather quickly run through them, not read them all.
Brahma sir, slides are not visible, please. Slides are not visible.
Sandeep ji?
Sandeep ji, presentation is not visible, sir.
नितिन जी आपका स्क्रीन पे प्रेजेंटेशन नहीं आ रहा?
नहीं आ रहा?
नो नो।
तो बताया नहीं मुझे किसी ने, क्या हो गया? Now is it visible?
Yes, yes.
Okay. So I'm sorry for that. Technical glitch probably. Is it visible now clearly?
Yes,
Yes, yes.
it is visible.
Okay. So I'll start from the first slide, the January webinars, February webinars, then March, April and May. There are interesting types like startup page, valuation of overseas investors from by Bharat Kuwadia. This would be probably the interesting topic for everyone to attend. Then valuation analysis techniques by Nainesh Singhvi. This would be the one, including the one which is today. Today's webinar, of course, is going to be most interesting. Valuation of guarantees and the binomial model. So Nitish ji will dwell upon that in a short while from now. So to highlight, we have covered the webinars right up to October, that is 21st October of this year. So we have a lot of things which are upcoming, and Sandeep ji is constantly into action. He is contacting many more speakers, and new topics will come. So he will be ready definitely within next month. He will be ready for the next 3 months. That is up to December. Probably he will. Sandeep ji, am I right?
Yes, yes, sure.
Yeah. So he is constantly on the run. He is constantly trying to find out different topics and different speakers. So worth, or rather a dearth of, wealth of knowledge he will be presenting to us. So if you have any queries, you can contact Mr. Bhave, who is the president of AVP. This is his number. Then for membership assistance, you can contact me. This is my number. And for any webinar related queries, like if you want to participate as a speaker, you can contact Mr. Sandeep Agrawal. This is his number. You can take a screenshot of this page and keep with you so that you have all numbers. So thank you very much. Now I again welcome you all to this session by CA Nitish Chugh. And I would now request Sangeeta Parmar to introduce our speaker today. Sangeeta, are you there?
Yes, sir.
Yeah. So please introduce Mr. Nitish Chugh. I'll stop the
Thank you.
sharing now.
Yes, yes, sir.
Thank you, sir.
Yeah.
I would like to start with the 2 lines of Helen Keller. Alone we can do so little, together we can achieve so much. Here at Association of Valuation Profession, we also follow the same spirit under the guidance of President Ram Mohan Bhave sir. And for that, I would like to welcome all the attendees who have not member to become the part of this big group so that you can also achieve the big. I would like to thank you, Nitin Brahma sir, Sandeep Agrawal sir, and would like to welcome all the guests for providing me the opportunity to introduce our speaker of the day, Nitish Chugh. Nitish Chugh sir has a long list of qualifications suffixing his name. BCom Honors, CA, Diploma in Information Audit, Certified Arbitration Professional, Company Secretary, Diploma in Insurance Risk and Management, Diploma in IFRS, IP, RV, Forensic Auditor, and Certified Blockchain Technology Expert. Independent director. He works as a partner in Hands and Associate, a CA firm in Faridabad. Chairman of Emerging Business Chamber of Commerce. This learned professional is today amongst us to guide us on the binomial model of option valuation and valuation of guarantees. Without much further delay, I hand over the proceeding to the Nitish sir for his presentation. Over to you, Nitish sir.
Thank you, Sangeeta ji. Thanks a lot for such a lovely introduction of mine. And I also thank Nitin ji and Sandeep ji and members who are present in today's webinar. Let me share the presentation for today.
I hope you have been made the co-host.
Yes, yes, yes.
Yeah.
Yeah, okay. Yeah. Sir, if the participants have any questions, we can take them at the end, post your entire presentation.
So is my presentation visible?
Yeah. Yes, perfectly visible.
Yeah. So we'll be covering today the introduction to options. What is how do we classify the options? Then very briefly the Black-Scholes models, as well as in detail we'll study the binomial model. That is the topic for today, and we'll do two practical questions on valuation of call and put by using the binomial model. Plus we'll see how do we value the guarantees, the financial guarantees. So what is an option? An option gives the owner the right but not the obligation to buy or sell an underlying asset. It gives the right to the owner. Call option, it gives the right to buy a particular or an underlying asset, and in a put option, it gives the owner a right to sell the asset. It's not the obligation, but the right at a predetermined strike price during a period or on a specified date. If it's during a period, it is an American option. If it's on a specified date after a particular period, it is a European option. Based on this, these are the two categories. When an option is allowed to be exercised only on the maturity date, if it's on the maturity date, it is European option. If it's on the anytime before the maturity date, then it's the American option. Right? I hope this is the basics and everyone is well versed with these terminologies. A call option is an option to buy an asset, and put option is an option to sell an asset. Right? There are certain terms which are used. First one is the expiration date. Expiration date is the day on which the option matures. That is the maturity day. Strike price is the price at which an option can be exercised. So this can be said as exercise price. Then in the money option. In the money option is an option that would lead to a positive cash flow to the holder if it is exercised immediately. For example, you have purchased a call option and the strike price is 100 rupees with a strike price of 100 rupees. Market price is more than 100, or say, let us hypothetically, it is 150. So at the time of exercising this right, you will have a gain of rupees 50. So this is called in the money option. At the money option is an option that would lead to zero cash flow if it is exercised immediately. That means the strike price is equal to the market price, whether it is a call option or a put option, it does not matter. The exercise price is equivalent to the market price. Out of the money option is an option that would lead to negative cash flow if it is exercised immediately. So the market price is, in a call option, the market price is higher than the exercise price, market price is lower than the exercise price, and in a put option, it is higher than the exercise price. So that in that case, any prudent soul on this earth will not exercise the option, and it is called out of the money option. Let us have a very brief intro of this Black-Scholes model. It is being developed by three economists, Fisher Black, Maron-Scholes, and Robert Merton. And it is widely known as an option pricing model. There is an assumption. The first one is it is a European style option. Only European style option can be measured by using this Black-Scholes models. For more complex models, we use binomials. Model assumes the normal log property of stock prices. That is, the changes in the stock prices are normally distributed. No equity dividends are factored in the original model. Equity dividends were not factored in the original model, but this has been later refined to incorporate equity dividends as well. So this is the formula. Looks like a very complex formula for Black-Scholes, but a simple interpretation could be representative of the present value of the expected payoff of the option at the expiration. Basically, S is the stock price, C stands for the call premium, S is the stock price, and K is the exercise price or the option striking price, R stands for risk-free interest rate, N is the cumulative standard normal distribution, and D1 and D2 are the two exponents which is being given in the formula. By using this formula or by using the option calculator, we can arrive the value of call or put based upon the inputs. These are the inputs required. Now, straight away moving to the binomial model, we will be covering this in detail. The binomial model is more advanced and involves the use of computational techniques. In this model, the share price is projected from the date of grant to the date of exercise using up and down approach. You can see, as the name suggests, binomial, it is two. Either the price will go upwards or downwards. This is The price will go upwards or downwards. It can move in two directions. So this is called the binomial model. The share price is projected from the date of grant. This is the date of grant to the date of exercise. This could be the date of exercise using the up and down probabilities. So this is the probability of moving upwards, and 1 minus P is the probability of moving downwards. This option is an American style option which can be exercised at any time up to the expiration. You can value the American style option by using this binomial model. Model assumes that binomial distribution of stock prices. That means it can move either upward or downwards. Basic premise is that at any given point in time, the share price can move in two directions to two different possible outcomes. It involves creation of various nodes over different time intervals. So as you can see, this is nodes and 0. This is node. This is also a node. It takes the shape of a tree, inverted tree. Involves creation of various nodes over different time intervals. At each node, it calculates expected share price and expected option value. So this is the expected share price and the value we calculate by using the, we'll see the practical also on this. The probability of up jump is e raised to power r minus d divided by u minus d. What is u? U is the ratio of higher price oblique stock price, right? U is ratio of price oblique price, whereas d is ratio of price and stock price. E raised to power r is the capital R, that is the value that I'll get after a particular period, assuming the risk-free rate, right? So we'll see a practical on this. Suppose the valuation date is 1st of April. Current stock price is 500. Exercise price is 510. Period, for the sake of simplicity, I've taken 1 year. Risk-free rate is 10%. And price on maturity as expected can be either 600 or 400, right? So we'll try to solve this function. We'll try to solve this formula. I hope my screen is visible. Whiteboard is visible?
Yes.
Yeah. So I'll write the question once again here. The option current stock price is 500. Exercise price is 510.
No, your whiteboard is not visible.
Whiteboard is not visible. Okay.
No, we are seeing the same slides again.
Now is it visible?
Now. Yes.
Okay.
Correct.
So stock price is 500, exercise price is 510, and risk-free rate is 10%. So what we'll do is we'll try to create a binomial tree. This is node 0, at node 0 and 0. 500 is the price.
Any issue, Nitish ji?
I think speaker is not available.
Yeah, he's got disconnected probably. Yeah, there is some problem with his connectivity. He's facing some issues. He's trying to join back.
Brahma sir or Sandeep sir, someone need to send a message to the speaker that he will
Yeah,
understand that.
I just
Yeah,
spoke to
yeah.
him.
Okay, sir. Thank you, sir.
He
Thank you,
said that he has some issues with the internet connection.
sir.
So
Sir.
he's trying to connect it back.
Thank you, sir. Thank you, sir.
Yeah. कुछ मेजर इश्यू है क्या सर? Login means you are not able to connect to the Zoom. So you just shut down and bring it up again or restart your computer. You done that. So you got the link, no? You just connect it through the link. So that it's not allowing you even connecting through the link. Yeah. He says the Zoom is not allowing him to log in. So maybe he will try to join through the link.
Okay, fine.
So we were talking good about the online mode. These are the disadvantages.
Sometimes it happens.
Yeah.
You can resend a link to him, sir.
Resend the link. That is, we can try. Yeah, it's there. Yeah, we have to make him co-host again. Co-host. Yeah. Niti ji, you are the co-host now again.
Sorry for the technical glitch.
Yeah, it happens. We were just talking about that online has some disadvantages also.
No, but Zoom is having this problem. Otherwise, Google Meet is quite good. So we were here only.
Yeah.
The current price is 500, and it is expected to move upward to at the end of the year, period 1, to either 600 rupees or to rupees 400. Right?
Sorry, will this difference always be the same for upward and
No.
downward?
This is for the purpose of simplicity. I have taken this example. It can move upward 20% and it can move downward 10% or 5% based upon the expectation of the investor. Right?
Yeah.
So the first step is to calculate. What is my U. U is the ratio of my upper price divided by my current stock price. Right? 600/500. That is 1.2. Then in the next step, we have to calculate D. D is the ratio of my down price divided by my current stock price. This is 0.8, right? Now, the next step is very, very important to calculate the probability of this up price and the probability of down price. So what is the probability? Formula for probability, e raised to power r minus d divided by u minus d, right? E raised to power r is rate of interest is 10%. So I can presume 1.1 at the end of year 1 minus d is 0.8, 1.2 minus 0.8. So my probability of up price is 0.3 upon 0.4, that is 75%, or I can say 0.75. 0.75. This is always P, and then this one is 1 minus P. 1 minus P will be 0.25. Right? So far, everything clear?
Sir, Sir Nidhi here. Sir, I have one question to ask. Sir,
Yeah.
how in real life scenario, 600 will be calculated? Like current stock price
This is based upon your expectation. Going to buy a call, that means expecting the stock move upward. My current price 500, you taking a call up at 500. So you are expecting the stock price to move upward. What is your expectation? Where will the price go? You are expecting the price to move upward 20% or 10% or 5%. That is based upon what is your expectation. That is why you will take this option now.
Okay, sir.
Right? So the probability of upward is 0.75 and probability of downwards is 0.25. Price is 600 and 400. These are the fundamentals that we have calculated. Now, what we have to calculate.
Sorry, sir. So this formula can be calculated for a private company as well?
This is for everyone.
Okay.
This is the formula for preparation of this binomial tree.
Okay, sir.
Right?
So is it possible that the upward will be 0.25 and downward will be 0.75?
Why not? In a put option, it will be this only.
Okay, only in put option.
It can be based upon any scenario, right?
Right.
So this is the thing. Now what we have to calculate is the gross payoff at this node. Let us name these nodes A, B, and C, right? Now what we have to calculate is the gross payoff. Gross payoff at node B and node C. So considering this as a call option where the stock price has moved to 600 and you have a exercise price of 510. So what is your gross payoff? Will you exercise this option? First question is, will you exercise this option or not?
Yes, yes.
You will definitely exercise this option. So what is the gross payoff? 600 minus 510. You will get 90 rupees. Advantage of 90 rupees. At node C, the price has moved downwards to 400 rupees. And the exercise price is 510. Will you exercise the option? No. So gross payoff is 0. Now what we have to calculate is the present value of this payoff. Since this is at the end of the year, we have to calculate it today. First of all, we have to adjust it for the probabilities. What is 90 into 0.75? 67.5, right? This is 0. So my present value of this payoff is equal to 67.5 divided by 1.1. This comes out to be 61 point,
Again problem?
Yeah, again problem.
67.5 divided by 1.1.
Yeah, it comes out to
61.4.
61.4, right? So this is the present value of this call option by using this binomial model, right? My entire system is hanged now.
But we can hear you.
Yes.
How that is happening?
I don't know. Zoom is working, I think, and the entire system is hanged.
So that means Zoom is good. Problem with your system.
It could be. In this case.
You can try to switch off your video and then speak. Probably that will conserve some bandwidth. Sometimes it happens with Zoom or rather with any computer. Is your internet connection powerful?
Yeah, it's very powerful. We're using 5G.
You do not have any issue.
Let me restart it again then.
There is a problem with sharing or there is a problem with the whiteboard?
No, the entire system hanged up. I cannot move my cursor or anything.
Maybe disabling through the task manager.
Task manager is not.
They again got cut off.
Hello?
Yeah, you are
Yeah, yeah.
audible, visible, audible, please.
Right. So we have done this example and the value is almost same. We have reached to 61.4 and the answer is 61.36. It's almost the same value. Now we'll have one more example which is related to this multi-period. We have covered this. The previous example is for 1 year period. Now we'll be covering it for 2 year period. Let me read the example for you. The evaluation date is 1st of April. Current stock price is 1500. Exercise price is 1700. Period is 2 years. Risk-free rate is 6%. And there is an expectation that the share price will move either upward or downward in first year by 10% and in second year by 15%. We will value the put option this time, right? 1500 is the current stock price, 1700 is the exercise price, 2-year period. Risk-free rate is 6%. Movement in first year is 10%, and movement in second year is 15%. We will try to solve this question both by way of American option as well as European option. So let me start. 1500 is our starting price. First
your
year,
sharing is off. Your sharing is gone off.
Sharing is off.
Yeah.
Nitish, sir, if you close your camera, it will not get disconnected, sir.
Close कर देते हैं. Okay.
Yeah.
So
Hopefully it should be okay now.
the expected movement in year 1 is 15%. 10%. So it will move to 1650, and this will move down to 1350. Right? The second year, this is node A, this is node B, this is node C. N is equal to 0 here, N is equal to 1, and then N equal to 2. In the second year, it will move up by 15%. So 1650 into 15%. It will be 1897.5. 1897.5. $140.02.5. $1552.5. $1147.5. Right? So these are the expected share prices that is given in the question. We just have to calculate first is the upper price and the U and D, and then the probabilities of upsize and downsize. So what is the U for this movement A to B? U equal to the ratio of upper price divided by lower price, that is 1.1. Since we have moved it by 10%, so it is 1.1, right? And D is equivalent to 1350 divided by 1500, 0.9. Clear? Are you there?
Yes.
Yeah, okay. Now, you see what is the probability? We'll calculate. Next step is to calculate the probability. Probability is equivalent to
E to the power R.
ER minus D upon U minus D. So rate of interest in this case is 6%. So I'll use 1.06 minus 0.9 divided by 1.1 minus 0.9. Right? Let me solve this on calculator. 1.06 minus 0.9 divided by 0.2. 80%. So 1 minus P will be 20%. probability here is 0.8, downside is 0.2, right?
Yes.
For next step also, for this also, we will calculate the probability.
One thing, want to ask one more time. Sorry.
Yeah.
So, how to
Yes.
calculate the rate of interest in real scenario? So,
Rate of interest in real scenario is equivalent to the tenure of the instrument. So if you have taken a 2-year period for this, then you will have to calculate RBI risk-free rate for a 2-year security period.
okay.
What is the risk-free rate?
Risk-free rate. Okay, sir.
Yeah.
Sure.
Yeah.
Thank you, sir.
So for this also, you will be, for this portion, U is equivalent to 1897.5 divided by 1650. It will come to 1.15, and D will be 0.85, since we have increased it by 15% and decreased it by 15% only. So U and D will be this. Probability will be 1.06 minus 0.85 divided by 1.15 minus 0.85, right? Let me solve this on calculator. 1.06 minus 0.85 divided by 0.3 will come 70%, right?
Yeah.
70% is there. 1 minus P is 30%. So 0.75 here and 70%, 0.70 and 0.30 here. You will calculate, it will come to same here because we have taken the same principle, movement of 15% upward and 15% downwards, right? Now, what is the next step? Next step is to calculate the gross
Cost
payoff, right?
Gross payoff.
Gross payoff. Gross payoff. The exercise price was 1700 and it is a put option. The market value is 1897.5. Will you exercise the option?
No.
No, you will not exercise the option. So the gross payoff at this point will be 0. At this is node D, E, F, and G. So at D it is 0. At E it is equal to 1700 minus 1402.5. That is somewhere around 297.5. And at F it is equivalent to 147.5. And at G it is equivalent to 1700 minus 152.5. So 552.5. 552.5. Right? Now, see, we are considering this as an American option, not a European option. अगर ये European option होगा, if we consider it as a European option, then very simple, multiply the percentages and this will be the value of the call. Can you help me in this? 297.
89.25.
89.25.
103.25.
103.25.
165.75.
165.75. So now what I have to calculate is I have to discount it to come to the level at node B, right? This, if this is an European option, you sum all these, you will get the value of the option of the put option, right? But now, since this is the American option, of course, we have to discount it for, reaching at level B. This is at end of year 2. Now we have to come to year 1. So what will I do? I'll discount by risk-free rate. So 89.25 divided by 1.06.
84.20.
Very good. And for this, we can add both of them for the and divided by 1.06.
253.77.
253.77. Now a very important step is coming up. The value. Now we have to calculate gross payoff at point B, at node B. Right? Gross payoff at node B is equivalent to strike price is 1700, my stock price is 1650, and it's a put option. Will I exercise the option? Yes. The gross payoff will be 50. Or this calculation which I have done, whichever is higher. Right? So higher of maximum of these two, it will be 84.2. Right? For node C, I'll do the same calculation. 1700 is the stock price, 1700 is the exercise price. The stock price is 1350. What will be my gross payoff? 350 or 253.77, whichever is higher. So it will be 350, right? Now again, I have to come back to point A. What will I do? I'll do another round of discounting. This I have done at the end of year 2 and I reached at the end of year 1. Now I am doing again the discounting and I'll reach value of option. Right? So yes. 84.2. What is the probability of earning 84.2? 0.8.
80%.
Right?
Yeah.
Plus. What is the probability of earning 350? 20%. Right? Then again, discounted. This is the value of put under an American option. Solve करें इसको. 84.2 multiplied by 80%, it is 67.36. And plus
the total answer is 129.58.
Okay.
67.36 plus 70 divided by 1.06.
So what is the final answer?
No, 129.58.
129.58. So this is the value of put option under the American option. Value of put under the American option. Now, if I have to calculate the value of put under European option, what I have to do? In this case, this comparison will not be done. this comparison will not be done because I don't have the right to exercise this option at either of the node. I cannot, call for or sell the asset or exercise the option at point B, at node B or at node C. I have to exercise the option at the end of year 2 only, right? So what will I do is, I'll not do the comparison. My gross payoff will be 84.2 multiplied by 0.8 plus 253.77 multiplied by 20% probability and discounted to reach at level A, N0. So it will always be lesser than the American option. Can you see the difference?
111.43.
111.43, right? So the value of option under an European option is value of put in European option is 111.43 in this example, and under the American option it's 129.58. Value of European option will always be lower whether it is a call option or put option as compared to the American option, or it may be equivalent to the same. Right? Is this example clear? And this is the tree which we prepare. This is an inverted tree, binomial tree. And this is the binomial model. This sums up the binomial model.
So how do we know which is the American option or European? Will it be given?
That will be given.
Okay.
For exam point of view, it will be given. For practical life also, it will be given whether the option is an American option or a European option.
Right. So accordingly, you have to deal with.
Yeah.
Yeah, Nidhi, please ask your question.
Yes, sorry, Nitish sir, just wanted to understand how that will be given in practical scenario.
This is the practical example that I have shared with you. So
he's saying actual scenario when one has to deal with the options, how that American or European will be told. That is what our question is. Am I right?
So that will be as per the contract only.
Contract.
Okay. Okay.
That will be given in the contract. Once you enter into derivative contracts or option contract, it's given in the contract itself, whether it's American or European.
So the same principle will apply for the valuation of ESOP as well, right, sir?
For the valuation of
ESOP?
ESOPs, the same thing will apply, but in that case, it will be a European option. Normally, American option नहीं देते हैं ESOPs के case में.
Yes, sir.
And Black-Scholes is more important or more,
practical
for valuing the ESOPs.
But in situations like we should value stock basis both the models, right?
Right. So value will be almost same. There is very slight differences between the same. We use the calculator for the same. For Black-Scholes also we use the calculator. For binomial also we use the calculator, and value is almost the same. So ESOP is always a call option. It can never be a put option.
It is always a call. Right. Right.
So ESOP is always a call option, and there is not much difference between the two.
Yes.
We can use any model.
You can use any model.
Sure. Thank you, sir.
Yeah. In Black-Scholes, they have now modified the earlier formula, and they have included dividend model also, in which case you have to adjust the dividend also. In binomial also, if there is a dividend, you need to adjust the same, right? So it is normally,
how do we adjust that? Can you tell?
It will be a very lengthy process. Basically, it is adjusted from this return.
Okay.
Right? There are two ways of adjusting the dividend. The first one is dividend in the short run and dividend in the long run. So if you have a call option or a put option for 3 months, right? And you are expecting the dividend to be paid within that period. So what will you do? You have to adjust the stock price itself. SO. SO needs to be adjusted in case of dividend for a short term. For long term, the rate of return needs to be adjusted. Right?
Yes.
Well, we can have a separate session on Black-Scholes in the future where we can, practically solve these questions relating to dividend as well as the Black-Scholes model. Right?
संदीप जी नोट कर लीजिए.
That will be very, very clear for you. Right?
Yeah,
now
we have
moving
noted
on to the slide.
Yes, see. Okay.
So this is the value of put option. I'll
Sir,
request
slide
you.
share कीजिए. Please share the slide.
This is the value of the put option. I'll request you to go through this example once again and try to solve it from the viewpoint of a call option holder.
Will your slides be shared, sir, with us?
Yeah, that I'll share you. Don't worry about that. Now there are certain, factors which affects the call price and the put value. So these are the factors which I've summarized. Increase in the underlying asset value. If the value of the stock price is increased, in that case, what will the impact on call value? The call value will automatically increase and the put value will decrease. If the strike price increases, suppose the current stock price is 100 and the exercise price is 110, and the exercise price is increased, in that case, the value of call will come down and put value will increase. Right? If the standard deviation is changed, if the variance is changed, is increased, then the value of call will also improve. Similarly, with the time to expiration is an exception, whether it is a call option or a put option. If time to maturity is increased, the value of call will also increase and the value of put will also increase. If the interest rate is increased, then also the value of call will increase. The reason being, what we do is we try to bring the gross payoff or in Black-Scholes model, my exercise price to the present value. So when the interest rate increases, the value of payoff will decrease, thereby increasing the call value, right? And dividend will have a different opposite impact, because of the simple reason that it reduces the value of the firm, value of the entity. Thereby, if the dividend paid is increased, it will reduce the value of the call and vice versa. Right? Moving to the other part of the presentation today, valuation of financial guarantees. Sir, time कितना है अपने पास?
Sir, you can go till 8:15.
Okay. Okay. Any query related to this binomial model?
Anybody other than Nidhi has any queries? No, I think.
So let us move to financial guarantee part. So what is a financial guarantee? Ind AS 109, defines a financial guarantee contract as a contract that requires the issuer to make specified payments. Issuer of a guarantee to make specified payments to reimburse the holder of for a loss. Holder means here it can be lender of the loan. For a loss, it incurs because of a specified debtor fails. Specified debtor कौन हुआ यहाँ पे? The borrower. To make payment when due in accordance with the original or modified terms of a debt instrument. So there are three parties involved in this financial guarantee contract. The first one is the borrower. Borrower is liable to repay the loan that they have taken from the lender. Lender is the guaranteed party who has been given guarantee by the responsible party, right? The responsible party here means the guarantor. In case of a default of repayment by the borrower, guarantor will make good the losses to the lender, guaranteed party, right? A guarantee is the assumption of responsibility for payment of a debt or performance of an obligation if the liable party fails to perform to expectations, right? Generally, what happens in case of a subsidiary holding relationship, subsidiary is a newly formed entity and they take borrowing from the banks due to their lack of credit score or rating or due to unavailability of information, they get very high rate of interest. In that case, what happens? The holding company gives guarantee that in case the borrower entity is not able to pay the loan, guarantor, the holding entity, will pay off the loan. In that case, there is a benefit that is being passed on to the subsidiary company by way of reduced rate of interest. That is why these guarantees are being given by holding company to a subsidiary company. Guarantee to an unrelated entity is a rarity. It cannot happen. It does not happen generally in India. सड़क पे चलते हुए कोई किसी की गारंटी नहीं देता. It happens only in case of a relationship. So there are two underlying principles for this valuation, how to value a guarantee. The first one is the value of
screen slide sharing mode पे कर दीजिए.
The value of a risk-free transaction is equal to the value of risky transaction plus the value of guarantee. So this is a simple equation. Value of risk-free transaction is equal to value of risky transaction plus the value of a guarantee, right? Suppose from the bank's point of view, what is the value of a risk-free transaction? The entity has given loan to a subsidiary. That amount, that is the value of a risky transaction, plus the guarantee that has been given by the holding entity, right? Now, if we change the equation, value of guarantee will be equivalent to value of risk-free transaction minus the value of risky transaction. Is it clear? This is the first underlying principle to value the guarantee, right? Second, the second basic valuation principle is that value of any contingent liability, including guarantees, equals its expected present value. Value of guarantee equivalent to present value of the probability weighted estimated cash flows. So whatever is the saving, whatever is the probability of weighted estimated cash flows is the value of the guarantee. So these are the underlying principles. Now let us move on to the methods of valuation. How do we value the guarantees? The first one is market value method. First, this is the very simplest method to apply. And if you know the hierarchy of valuation also, there are three levels, level 1, level 2, and level 3. And this is consistent with level 1 of the fair value hierarchy as per Ind AS 113. and it applies in generally two cases. In the first case, the comparable risk-free, that is the guaranteed, and risky, that is the non-guaranteed instruments, exist with the liable party. That means the subsidiary is having both guaranteed, that is risk-free loan, as well as the non-guaranteed risky loan. The entity, the holding entity is itself having those loans. The market value of these instruments are known, and the value of guarantee is simply the difference in the value of risky and risk-free instruments, right? This could be applied to a guarantee on an entity that both has typically risky debt and guaranteed debt. So if an entity is having both risky debt as well as the guaranteed debt, in that case, what is the value? The value of guarantee is equivalent to the difference of the same. In the second case, what happens is a fee is received for providing the guarantee, and the guarantee fee is equal to the guarantee's value is equal to the fee. For example, a bank is charging a 2% guarantee fee for providing guarantee for a loan, right? Generally, banks guarantee loan ki nahi dete, they give performance bank guarantee only. So what we do is we approach the banks and we ask them, had this guarantee been given by a bank instead of a holding subsidiary relationship, had this guarantee been given by the bank, what would be the fees of the bank? What the bank would have charged from the borrower? That is the simplest way to identify a fee that is being charged by a financial institution or by a bank to provide the guarantee is equivalent to the guarantee fee, is equal to the guarantee value, right? This is the first method. Second method is the present value of cost saving. This method is based on the first valuation principle, that is the value of guarantee is equal to value of risky transaction minus value of risky transaction. Under this approach, what happens? The fair value of guarantee is equivalent to the present value of the saving of interest or similar cash flows in respect of the guaranteed loan as compared to the cash flows, what they would have been. This is very, very important. What they would have been in case of unguaranteed loan amount. If the holding company has not given the guarantee, then what would have been the rate of interest charged by the bank versus what is the rate now charged after guarantee, right? For example, rate of interest with guarantee is 10% and rate of interest without guarantee is equivalent to 12%. So the differential, what is the differential? Differential 2% is the saving of interest or similar cash flows in respect of this guaranteed loan as compared to the cash flows that would have been in case of an unguaranteed amount. मतलब इन दोनों का जो difference होगा, जो cash flows का difference होगा, we have to discount these cash flows or savings by discount rate had there been no guarantee. Clear? This is the basic premise in all the accounting standards in 109, in case of compound financial instruments, in case of guarantees, in case of CCPS, in case of optionally preference shares, in case of optionally convertible debentures, that you discount the cash flows by the rate what would have been charged had that conversion option is not there? What would have been charged had that guaranteed been not there? What would have been charged that in case the parties are not related, right? So this is the promise. This is very, very important. What they would have been. So difference in the cash flows divided, discounted by the rate had there been no guarantee will give you the present value of the cost saving, right? You want to do a quick example of this because this is what is the initial recognition. This is the initial recognition. So let us see a quick example on this.
Mukul Puranik sir, you had a question. Vichara tumcha prashna.
We will plan a question, sir. Don't worry. Suppose an entity X. Wait. Is it sharing now?
No.
Whiteboard is sharing? No.
Yeah, now it's sharing.
Okay. This entity X had given a guarantee for its subsidiary Y, right? The amount of loan is, let's for the sake of simplicity, let it be 10 lakhs. Right. Tenure of loan is 3 years. Right. Rate of interest is 10%. Had there been no guarantee, rate of interest would have been, let it be 15%. Right? Now, what we'll do, we'll plot the cash flows. Cash flows for 3 years. It could be the cash flows for 3 years, or it could be the saving of interest for 3 years. Assuming that loan is to be repaid after 3 years and interest payment is to be made at the end of each year. What will be my saving of interest on year 1? It will be 5% on 10 lakh. Let it be 1 crore. So it will be 5 lakhs. Right? For year 2, 5 lakhs. For year 3, this is also 5 lakhs. Now, what I have to do is I have to discount these cost savings at the rate had there been no guarantee, 15%. So what is my discounting factor? It's 0.86.
8696. 0.869.
96. 0.7561.
0.6575.
0.6575. Right. So my total saving will be 11,41,608. So this is my saving of interest due to guarantee. right? And Ind AS 109 says that you have to recognize this amount as your liability. This is the financial liability. So my accounting entry at this point of time, accounting entry at this point of time, this is initial recognition. Initial recognition is, since this amount will not be recovered from subsidiary, what will I do is I'll book this as investment in subsidiary, investment in Y2, financial liability to guarantee value. I'll credit this amount 11.41. Now this is my initial recognition, right? After this is at the time of entering into the contract. Now at the end of year one, my one year has lapsed. So what is my saving? 5 lakhs and 5 lakhs, right? So what will amount of guarantee? Amount of guarantee will be equivalent to, year has lapsed. Now I have to discount 5 lakhs by this factors, right? Not by the third one. It will 0.86, 0.7561 into 5 lakh. It will be 8,12,850. Right? So what does the standard says? This is due as per the EIR method we have calculated 8,12,850 based upon the present value of cost saving due to interest, similar cash flow. This is the amount of guarantee. Now you compare it with, or you compare it with the expected loss. That means as per 109, if credit rating of Y has changed during the year, then you follow lifetime expected credit loss method. Else use 12-month expected credit loss method. We call it as ECL method. Right? अगर क्रेडिट रेटिंग चेंज हो गई है, क्रेडिट रेटिंग खराब हो गई है, इन दैट केस आपको एस्टिमेट करना पड़ेगा कि ओवर द रिमेनिंग यूजफुल लाइफ, दैट इज द लाइफ टाइम, व्हाट इज द लाइफ टाइम ऑफ दिस पर्टिकुलर contract, that is the remaining 2 years, what is the expected credit loss that the entity may incur, right? Based upon the financial projections, based upon other parameters, you calculate what is the probability of default and what is the expected amount of default, right? Now suppose you calculate it as 10%. So my exposure is 1 crore, 10% you have calculated, it is 10 lakh rupees. The standard says you have to compare both the amount. This is as per EIR accounting and this is as per ECL method, and you have to account for the higher of the two. Right? Now, my initial recognition was 11.41. My subsequent recognition is 10 lakhs. My difference will be charged to statement of profit and loss or credited to statement of profit and loss. I can say it will be transferred to profit and loss as fair value changes. Right? This is my initial recognition. This is my subsequent recognition. There is one more criteria. If the credit is impaired, that means the entity credit has is worse or negative, it's in minus, triple C, triple D, or the credit rating of the entity is impaired due to any XYZ reason, then you have to provide for the full amount of loan as the fair value of guarantee. Fair value of guarantee. This is exception. This is normally used 12-month ECL method or lifetime expected credit method. Right? Any doubts in here? This is the most widely used method. After the first one, this is the most widely used method, and this has been, used by most of the big fours as well. And this is used not only in India, across the world. Right? Any doubts here?
I have one doubt. So,
yeah, please.
How do you get this ROI without guarantee?
Yeah, so this you contact the bank only. Based upon the credit rating of the entity, if the guarantee would not have been given, what would have been the rate of interest? It sometimes you get this rate at the time of entering into the contract, when there is negotiation that the holding company will provide the guarantee. So you reduce the rate of interest by 1%, 2%. And there are certain market research also available based upon the credit ratings, how much will be the saving. Generally, 1 to 2% is the saving because of the guarantee given by the guarantor. But it also depends on individual case. Suppose the holding company की rating ही इतनी अच्छी नहीं है कि उसको saving ही नहीं हो पा रही कुछ. So it all depends based upon the negotiation at the time of entering into the contract, as well as the data which is available based upon the dealing with the banks.
Okay, thank you.
Okay, how 10% has come? ECL
that
method?
Is this one.
Yeah, 10%. Yes.
Yeah. 10% you calculate based upon, there is a concept of expected credit loss in India's 109 when you will study. So there is a concept of expected loss. There is a formula to deriving this value. What is the probability of default? What is the expected amount of default? And then you arrive at this figure. So these are all expected losses based upon the next 12 months period working and lifetime of the contract. Okay. In just भी category में आप fall करेंगे.
Okay. I have a doubt.
Yeah.
Can you tell me how that 8,12,850 is arrived at? That is a basic point. No.
Which one?
Amount of guarantee year one. Can you just give me the calculation for that?
This 812850?
Yes.
This one? Okay.
Yeah.
So at the end of year one, I had paid one installment for interest, right? Now only 2 years are left. What will be my cost saving? My savings on interest after 1 year. So there will be only 2 cash flows at the end of year 2, at the end of year 2. My savings will be 5 lakh, right?
Yes, yes.
And discounting factor at the rate of 15% will be these two.
Point.
This one, 8696 and 7581.
Okay, okay, fine. I was
Right?
looking at the year 2 and year 3.
No. 1 year has passed, so this will be the discounting factor, not the third one. Right?
Okay, thanks.
There is one more method of valuing a guarantee. This is the contingent claim valuation method, and it is consistent with level 3 of the hierarchy. And it is based upon the second principle. Remember, we had 2 principles. This is the second principle, that value of guarantee is equivalent to present value of probability weighted estimated cash flows. In this case, there are 4 methods. First one is loan guarantee as a put option. This is the only option which I have used in my professional career till date. These 3 I have not used. These are theoretically there in the books or in the syllabus. This is the only option which can be used. Loan guarantee as a put option using Black-Scholes model. Right? I'll tell you the concept behind this. What is a loan guarantee? And how you can use it at a put option, right? So I'll insert one sheet in this. Wait. I'll insert a blank slide in this. Okay. Gone gaya? Yeah. So my screen is visible? Is my screen visible?
Yes, it is visible.
Yeah. Okay.
Blank screen.
Yeah, blank screen.
Yes.
So what is the value of my risky loan? Please. Value of my risky loan is equivalent to value of my risky transaction is equivalent to value of guarantee plus the value of risk-free transaction, right? Value of guarantee, value of risk-free transaction plus the value of guarantee, right? This is the definition we have seen so far today. Value of risky loan is equivalent to value of risk-free transaction plus the value of guarantee, right? So if I say from the viewpoint of bank, I had given a loan of rupees 1 lakh rupees, right? This is a risky transaction, and the borrower is able to pay only rupees 80,000, whereas I have an option, a put option to recover maximum of rupees 1 lakh rupees, or the shortfall from the guarantor, right? This is the value of guarantee. So from the banker's point of view, there is an option to recover the shortfall or the entire amount of loan. So this is a right to sell a particular asset. Right to sell a particular asset as an exercise price is a put option. So using this value, by this, derivation, we can derive that value of guarantee is equivalent to value of a put option using any of the model, whether it is binomial or Black-Scholes, right? Black-Scholes हम इसलिए यूज करते हैं क्योंकि पैरामीटर्स बहुत इजीली मिल जाते हैं. In Black-Scholes models, we use the share price, right, plus the volatility of share. For valuing a guarantee, we replace this share price with the value of the assets and the volatility of the share with the volatility of the assets. Because if the value of firm is more than the value of debt, or value of assets is more than the value of debt, in that case, probability of default is 0. Probability of default is 0. Right? This guarantee will come into the picture only when there is the value of assets. Value of assets is less than the value of debt. So if the value of assets is less than the value of debt, we have to consider these as a factor for determining the value of guarantee. That is why we take value of asset and the volatility of the assets, market value of the assets, as the input for valuing a guarantee. Right? Is it clear? Am I making sense?
Yes.
I think the presentation part is over. Now the house is open for queries. If you have any query, and before that, I'll request Damija sir to please enlighten us if I have missed anything. And I'm very, very sorry for the technical glitches.
There is a question in the chat box.
Right, sir.
Is there a concept of guarantee for government bonds and also NCDs?
Is there a concept of guarantee for government bonds and also NCD? NCD is
Non-convertible.
Non-convertible debentures. Definitely there is a concept of guarantee, because these are non-convertible, it has to be repaid. So therefore, guarantee can be given for the same. For government bonds, I don't think so there is any guarantee. The guarantee is the sovereign guarantee of the government only. So answer to the first part is no, and answer to the second part is right.
Yeah, thank you. Mukund sir, तुमचा question answer झाला का?
Thank you, Zala. Thank you.
Yeah. Dharmendra ji, your question was explain ECL method again. You want to?
No, he has explained.
Yes,
already explained.
Yeah. So we have about 1 minute to go. So you can ask the question. Anybody has any question? Yeah, so it seems all the questions have been answered. It was an excellent presentation.
There could be two possibilities, sir. Either the concept is clear or the concept is all clear.
No. Because if you ask me, my concepts were pretty clear.
Thank you, sir. Thank you.
Yeah. No, it was an excellent presentation, particularly the practical example that you gave, the 2 examples of the binomial model.
Right.
Those made the concepts of binomial model very clear.
Right.
because we only saw the theoretically those things put in the book or somewhere, but practically the way you have explained, that was excellent. So I hope everybody agrees. Now I request Mr. Manjunath to give vote of thanks.
It's my honor to propose the vote of thanks for today's program. I thank Mr. Nitish Chugh, the CA, CS, IP, and RV, the today's speaker, who spoke about binomial model and the valuation of guarantees. He explained about the options, both the American and European options, with the different methods and with the practical examples. And also he covered about the guarantees and the hierarchies of the different methods of the guarantees as per the Ind AS, and as well as it's applicable to the Ind AS. And he made the difficult subjects so easy to understand, and hope everyone has enjoyed it and gained the knowledge. In the outset, I thank Mr. Ram Mohan Bhave, President AVP, and Mr. Sandeep Agarwal, Head Professional Development AVP, and Mr. Nitin Brahma, the Head Resources Committee AVP, and Mrs. Sangeeta Parmar for introducing the speaker today's program, and all the governing council members of the AVP and IIV RAF for supporting this program, and all the participants for the today's program. And I request everyone to note down the dates of the upcoming programs of the AVP, and please do attend all the programs in coming days. And thank you so much.
Yeah, thank you, Manjunath ji.
Thank you.
If anybody
Thank you,
can
Nitin.
still ask the question, you can ask the question, although the vote of thanks has been proposed, but you can unofficially,
No problem.
we can still talk. We still have about 5 minutes to go before 8:30, 5 or 10 minutes, 13 minutes in fact.
10. Nidhi may be having some question. Nidhi, are you there?
Nidhi, yeah, Nidhi, she's there, but she has asked a lot of questions.
That is why I am saying that.
Yeah.
That makes my role very, very easy. When the questions come,
Yes.
so it
No,
becomes
actually,
very easy to explain them. Otherwise,
actually, it was good that you made it interactive rather than keeping the questions at the end.
Right.
Yes.
Because if you keep the questions at the end, you will have to again go back and refer to those slides where the question was raised. So I think thank you very much.
I think if he has to have, because initially he was Mr. Nitish was telling about he has so many qualifications on the plate. Only to, so I think for each qualification he has to have one system support, and so I think he has burdened his system with a lot of other many.
No, I don't know if this has happened for the first time, but what was the error? Or in fact, I don't use Zoom much. We do
so
all
much
our
of
meetings on Google
so
Meet.
much of data you have, because with so many qualifications, so much working, you have a lot of data, I think, in your system.
It is unbearable for the system itself.
So
Sandeep ji, you have noted down, no? Black-Scholes model पे एक webinar बनता है नीतीश जी का. खाली Black-Scholes नहीं होगा, उसके साथ कुछ और भी लेना पड़ेगा.
We'll have more from Nitish ji.
Black-Scholes and ESOPs will cover options and ESOPs.
Black dog.
Black dog. No, that is different. Okay, thank you very much. Thank you, Nitish ji.
Topic and you just select your topic and make me aware. So we will have one more webinar.
Sure, Sandeep ji, sure. Thanks everyone for the patience.
Thank you, Sandeep ji.
Thanks for the night delusion. Thank you very much. Thanks, Nitin ji.
Sir, you share your presentation. So that
I'll definitely share, sir.
Yeah. You can share it with Sandeep ji, or you can put it on that coordination group which you have created.
I'll put all the slides as well as the presentation on the group.
And you were asking about the membership of this. So you want to become a member, and rather we'll urge you to become a member.
Sir, I can.
You send the form to.
So you are not forming it an RVO,
You just send the form to him.
No, this is not an RVO.
Not RVO.
Okay, it just will be an association only, right?
Yeah.
Okay, then there is no issue. I'll become a member of this.
We are actually grappling with the fact that whether to make it a society or it's allowed, whether to make it a Section 8 company. So all those technical administrative formalities are going on right now.
But it will not be RVO. But
it
will not be an
RVO. Yeah, it's only a knowledge sharing platform that we are using it as.
We propose that we will get the knowledge sharing and points from the members from the study groups and propose some amendment or propose to be brought in the rules and regulation by IBBI or something like that also we propose.
Right.
So you are also
a learned person like you on the
So
platform of
you
AVP
become our
actually will help all those things.
Definitely, sir. I'll have to be a member of this.
Definitely.
Yes.
So Nitin ji, you send the form to Nitish ji today and
I'll send the
he will
form.
be.
Yeah. Yes.
Okay. Thank you very much.
Okay. Thank you.
Thank
Bye.
you.
Good night and have a nice weekend, all of you.
Thank you.
Yes. Thank you.
Thank you. Goodbye.